All right, guys, thank you for joining me. I just kicking this off now, and we're going to be live, and we are live. Suggest you guys welcome Ryan. Thank you for joining. Let me just put that on. Thanks for joining, guys. Ryan and Colin, thank you for joining in the live, and I will come to you. I suggest you keep your cameras off and your microphones on mute between now and when I open up for questions. At least when I open up for questions, you guys can come on stream. But between now and then, if you do have your camera on and your microphone on, all of the stuff we picked up inside the link, inside the YouTube live stream. So it's probably best not to. Welcome, guys. I'm just kicking off this week's roundtable, as I call it, and I've got some slides to share, and I will. In a moment now, I will be showing you those. Here we go. Yeah, okay, and I'm gonna swoop, make that down there. Yeah, okay, and we're off. So guys, welcome to this week's live stream. And what I do every week is bring you guys in for a bit of an update on news and events that are taking place in the real estate industry. And the idea is to just kind of my take on what's happening in the industry, what to perhaps expect in the coming months and weeks ahead. And there's an awful lot of stuff going on. I mean, literally, if you close your eyes for even a day, you're going to miss out on stuff that could potentially impact the market. I do this. You know, this is basically a follow-on from the weekly podcast that I do. I do the podcast Behind the Facade, real estate, everything like that. You'll find it all inside YouTube. I also have my personal YouTube channel, which this is live streaming to, called Gavin J. Gallagher on Real Estate. A quick reminder, I do this live stream every Wednesday at 1 o'clock. And if you're listening in from Ireland and UK, it's 1 o'clock, obviously, but there are some listeners that are looking in from the US, which is, it's 8 a.m. in New York. So this is more like a breakfast briefing for you guys. The guys in Dublin, it's a lunch and learn. I just call it the Property Investor Roundtable. Today's agenda is to cover real estate news. So much going on in the market. I think that's basically all I'm going to have time to cover. I will open the floor up, though, to some questions afterwards. So let's get stuck into real estate news. And the first thing I'm going to cover is the property sector. I always start with this. This is the Financial Times. The property sector is a great page to go through just for international property news. And you can see here that as of today, Taylor Wimpey, which is a massive house building company based in the UK, they have said now that demand for new homes is falling rapidly across the UK. And they're saying that they're selling homes now at a rate that is less than half of the pace that it was 1 year ago. And that will give you some idea of just the slowdown. And this is all part, like there's predictions now in the UK for a major recession and a multi-year recession. Typically, a recession is 2 quarters of negative GDP growth. But they're predicting that this will be the worst recession in a long time. So it's obviously having a negative impact on real estate prices. And I'm going to go into some of those things today. America also going through massive change in the real estate market. Here in Ireland, we're actually in reasonable shape, it seems at the moment anyway. And I expect that we might actually skirt the terrible fallout that you're going to see in other parts of the market, but we shall see. Another headline today in the property sector from the Financial Times is that the homeowners are not the only ones that are getting hurt, and there's actually there's a whole generation that are renting property that are now getting caught in this affordability squeeze. And the reason for that is kind of obvious. With inflation so high, we can see the cost of filling your car has gone up, the cost of paying for heating and electricity for your house has gone up. The cost of your grocery shopping and things like that has obviously also gone up. Holidays have gone up. Everything has gone up across the board. And if you're paying rent, then on top of that, then you're going to be in a situation where you're going to suddenly struggle. The amount of space to actually cover all of your expenses is cutting down. So when I'm saying the Irish housing market is in good shape, it's in good shape. What I mean by that is it is in better shape than the UK at the moment. We're not looking at a potential 30% fall in house prices. Now, good shape is all relative. If you own a property and you're looking at mortgage increases, then obviously it's not a great position to be in. Or if you're a person who can't afford to get into the market, it's not a great place to be in. But compared with 2008, when we had a massive fall in values, I mean, some of the property values fell by 60 to 70% in the Irish market. So we're not looking at that. So I would say that that is in better shape, certainly, than the US and the UK market at the moment. We have another bit of interesting news coming in, and that is from Persimmon or PLC, which is a housing development builder, house builder, and their shares have slid in the market because they are warning of increased uncertainty and in the market, in the housing sales market, and higher taxes and things like that. So all of this is certainly impacting the UK market. We haven't seen this yet in the Irish market, although there is a little bit of contagion, and you're starting to see it kind of creep into the Irish market too. Higher energy bills are pushing UK businesses to reassess office use. This is something that you're going to start to see more and more of, and it's not just energy usage. It's also the fact that people prefer to work from home, and there's obviously that whole sort of hybrid work system now that's coming into question. Stamp duty receipts in the UK hit record highs as the UK property market starts to cool. So it's unusual that this has been a bumper year, but it is a lagging indicator because it's based on last year's prices as opposed to this year's prices. And so stamp duty came in as a record high. That was because a lot of people bought last year, but a lot of people bought last year not expecting the turn in events that have taken place in the last, it's only like about 1 month since the whole market was turned on its head by Liz Truss and all of that stuff going on. And just from a couple of days ago, one of the headlines was that commercial property fire sales begin as property funds rush to kind of fill UK redemptions. Now, what is that mean? That like basically investors are starting to withdraw millions of pounds, and that is triggering sales of prime property. And so there's going to be a bit of a fire sale in the UK market in the commercial side. So it's interesting to watch. We have a comment coming in on the YouTube live, and it's from Evan. How do you know with respect to finance and commercial lending, who will lend below? I'll tell you what, Evan, stay watching. I'll cover questions at the end. I'm actually just going to get through the news section right now, and then I'll deal with some of that. So like basically last Wednesday, every Wednesday I do this, and last Wednesday afternoon, sure enough, the US entered their 6th interest rate hike in a row. And that it's basically the Federal Reserve in the US are fighting 40-year high in inflation. And when you're looking at 40-year high in inflation, then all bets are off in terms of being able to predict what's going to happen next. This is not something that you can kind of say, oh, this is what we normally do. You're at a kind of 4 decades since we saw inflation at this level. So it is concerning, obviously, the powers that be in the finance houses, and the Fed is the central bank in America, and it is trying to get inflation under control. So it went for another huge 0.75% increase in interest rates. And now America is at 4%. Now, having gone from 0.25% just about 6 months ago to 4% now, you can see what that's done to a lot of people. It is absolutely dreadful. And it's really having a cooling effect in the US market. But what's worse is when America does something like this, it has an impact across the world, because what it does is it strengthens the value of the US dollar. Every time they go up in their interest rate, it strengthens the dollar. And an awful lot of the assets around, like commodities around the world, are priced in US dollar because it's the reserve currency. And so it means that everything has gotten more expensive in other countries. So places like the EU, places like the UK, places, wherever you are, and Turkey in particular are feeling it because they're having to buy, their value of their currency in Turkey has massively fallen because they're dealing with 83% or 85% inflation now. Annual inflation in Turkey is currently in above 80%. And what that has done, it has completely devalued their currency to the point that the US dollar that they are having to buy all their fuel in, that is now 300% more expensive. Fuel costs are now 300% higher in Turkey than they were 6 months ago. So it's a massive problem for them. Turkey for your holidays. Turkey for your holidays is probably a good thing, except that, you just make sure you're flying on an airline that you can rely on, because if the economy collapses while you're there, you could be stuck, unable to return. And so there is issues to be with, but you're definitely seeing some value in Turkey. And there are predictions that the Turkish economy is going to collapse. And if you look at Argentina, which is another economy that's kind of gone through multiple collapses over the last, couple of decades, their interest rate currently, if you want to borrow money in Argentina, the interest rate is 75%. So you borrow 100 grand, and at the end of 12 months, you owe 175 grand. That gives you an idea of how out of kilter some countries are around the world compared to ourselves here in Ireland or in the UK, where 2 or 3% of an increase and we're all panicking. We're actually fairly okay comparatively with other countries in the rest of the world. The US, they're predicting that the rates will continue before the end of the year. It'll hit 4.4%. So you're looking at another 0.5% before the end of the year. And they don't believe that the rates will start to fall until 2024. So we have another year of this, and another year of what's going on is going to shake up the market. Let's just say it could well be that there's quite a bit of a shock in the system. Now, no sooner had the US done that, the following day, the Bank of England, which is the central bank controlling the UK pound and stuff, that went and it entered its a 0.75% increase as well, which is now the highest rate, it's the biggest rate increase since 1989. So we're talking about over 30 years since there was something like this. And the rates are now 3%. So it's quite extraordinary that, this kind of shock. It's for those of you who are watching in on TikTok who are wondering what's going on, this is a real estate and property market kind of review. So if you're interested in learning about the property market and how the news impacts and the events that are taking place in the world economy impact, it's going to be, I see somebody fixed with an LTV for 3 years. Great move. I mean, anyone who fixed a while back, it will have paid much, much less. And so they're going to be in good shape. But the decision to increase rates, like inflation in the UK, is also hitting a 40-year high. So the last time we struggled with inflation like this was way back in the 80s, and we're now in a situation where we're looking at trying to deal with inflation that we haven't seen in over 40 years. And so that is going to mean that all predictions are off, and it could well be that rates have to go substantially higher. And even if they go higher, I mean, already we're looking at potential recession because of the situation, but we shall have to see. They're saying that the UK rates are expected to peak at 4.75%. So it's going to be interesting. I see somebody messaging me about getting into this group. I'm just going to go and send them a quick invite. And so anyway, on to the next headline. We're looking at predictions for what's going on in the UK market. And they're saying that they're expecting now that the market could fall by up to 30% next year. So obviously a good time to go and buy in the UK if you're interested in that kind of thing. But the question is, what are you going to borrow or where are you going to borrow from? Because a lot of the banks are now withdrawing their mortgage products because of this uncertainty and because so few people can kind of tell so few people can tell how this is all going to play out, because it's very, very uncertain. We don't know whether interest rates will continue to rise. We don't know whether inflation is going to continue to rise. We don't know a huge amount of things. And if it continues to go like this, it'll just be total destruction of value. People will pull out. People will stop, will stop taking the risk, because you go to a bank, you go and borrow a load of money, and you don't know whether or not that interest rate is going to continue to rise. A lot of banks, if you look to fix, the difference between a fixed rate and a floating rate can be quite huge. And if you're in a situation where you're trying to, if you're in a situation where you're going to fix your rates, you might have to choose, or you might have to opt to pay 2 or 3% more than the floating rate. So it's very seductive to stay on the floating rate because you're immediately saving money. But the problem is you don't know what the forecasted rates increases are going to be. And if they continue to increase, then you could be in a situation where you start to get nervous. Then you decide to look to fix. And by that stage, the rates are even higher than where you could have fixed at. So that has happened to me before, and I'd be wary about that. They say that the buy-to-let market is where where they're likely to see the most stress in the residential market. And that's because increased interest rates, landlords are struggling now to break even, because they have the rents that they're charging their tenants, but their increased costs are going up. And a lot of cases in the UK anyway, they've got huge increases in electricity bills as well. And in some of the HMO models, the HMO model is the house and multiple occupation. In those models, you have usually the landlord is actually paying the electricity bill as well. And so you have to kind of have a look at the prospect of doing that. Anyway, let's get on to the next slide. One of the worrying things about this is the French central bank chief has forecasted that this current inflation fight against inflation, trying to get inflation back down to the levels that we were used to, which is around 2%. He reckons it's a 3-year fight to actually get that to happen. And if you're into 3 years, can you imagine, like at the moment, we're in this situation where it's only been 6 or, maybe since the Ukraine war started, that is when all of this kind of kicked off. And that is only March. So we're not even, a year, we're barely 6 months into this thing. And imagine another 2.5 to 3 years of this. It'll do a huge amount of destruction to the economy. The Eurozone inflation surged to 10.7% in October, which surpassed expectations. And this is the problem, is that the central banks are all being caught off on the back foot. They're kind of like, first of all, it came out in the US where they were talking about it being transitory. And what they meant was that this was just a passing fad and that it would all sort of, drift off and we'd all be back to normal very soon. They suddenly realized, whoa, this is not transitory. This is becoming embedded. And the worst thing about embedded inflation is that it leads to a wage spiral where everyone is demanding increased wages. Increased wages means increased costs. And it becomes this vicious cycle where it continues. And that's essentially what's happened in Turkey, which is why it's now at 80% there. And this can get completely out of control. If you look at places like, for example, Zimbabwe. Zimbabwe had normal levels of inflation back in the sort of 80s, and then they just started to lose control of it, and it ended up at something like 10,000%, where people needed a wheelbarrow in order to go and buy a loaf of bread. There was that much cash needed to hand over just to buy a loaf of bread. Anyway, they're saying that it's too early to say where this will all end, but they're expecting that the interest rate will continue to go. Where is the podcast? Where can I find it? The podcast is called Behind the Facade, and you can either find it in Apple and all of the usual podcast locations, but it also has its own YouTube channel. So I have 2 YouTube channels. I have Gavin J. Gallagher on real estate, and I have Behind the Facade, which is the real estate channel, and it's where I post all of these videos on the longer form videos, go to the YouTube podcast channel. Right. So what about back home here? And this is where we're all kind of worrying, like the UK market, they're talking about dropping 30%. US market's kind of falling now at the moment. Everybody's panicking a little bit. But here they're saying that house prices to keep on rising despite the economic slowdown. Now, this is kind of unusual to hear, but I've been predicting it for a while, primarily because of the supply-demand imbalances in the market. And what you're looking at here is, and this is actually a report from Sherry Fitzgerald, which are the big real estate agents here in Ireland. They have said that it's unlikely that Ireland will experience a price correction like it did back in 2008. And that is because the current slowdown, it is impacting demand, but there is just such a lack of supply that it is unlikely to make a dent. And they gave an example. She said that there were just 15,000 secondhand properties for sale nationally in the entire country in July. And this represents less than 1% of the total housing stock in the country. And it is down 34% on the previous, on the 2019 levels, which would be kind of more normalized pre-COVID. And so while demand for housing is expected to kind of shrink because household budgets are just going to get tighter and tighter, and interest rates are going up and all of that. However, because the supply of new homes and the supply just in general of homes is so critically or chronically low that it's going to keep a floor on house prices. And you're going to have people that will still buy because they're desperate to buy something, and they'll figure out a way to manage their costs or whatever. They are expecting to see the price growth that will slow. So what we've been struggling with here in Ireland is the rate of growth of house prices has been 12%. And what they're expecting now is that that will slow to 6 to 8% growth. Now, 6 to 8% is still pretty solid growth, but it is about half of the level that it has been. And that's down to just interest rates increasing and these inflationary pressures. The lady that, the CEO of Sherry Fitzgerald, she also mentioned that the downturn in consumer sentiment is connected with it's connected to the changing economic outlook and a lot of the job losses that are starting to happen in the tech sector. And I'm going to be going into that a little bit more today. But she said it's unlikely to make a dent to the essential part of the housing market. And that is really first-time buyers and people that are moving. And so those purchases are based on needs as opposed to kind of discretionary spend. And the people that are more well-to-do, the people that work in the tech sector and things like that, they could afford to kind of like make a choice, whereas other people are just desperate. So a new home purchaser they just need to get a home because they can't continue to live. They want to raise a family or whatever. Some listings, they're saying, are being withdrawal and some sales are falling through and some are then coming back on the market. This is kind of more normalized in the market. One thing people are nervous about, however, is the properties that require a huge amount of renovation and any kind of construction work. Those houses are taking longer because of the situation where there is just house prices. House prices are one thing, but if you got to go and get a builder or a contractor into your house, if you got to go and rewire it or whatever it might be, that is going to put pressure on people because of the construction cost inflation. And so this is an issue that a lot of people are dealing with. And so they're also saying just that this temporary moratorium on evictions that has brought out recently in the Irish market, like they say that it's laudable, but all we're doing is basically transferring the problem to the end of that moratorium. And so next March, suddenly it'll be time for that. Now, this is the week that COP27 has kicked off. And those of you who are wondering what COP27 is, it is this big climate action where all the governments meet together. And last year it was taking place in Glasgow in the UK. This year it's taking place in Egypt. And so COP27, it's all about trying to fix climate change and all that. Now, a lot of people, it's immediately got off to a bad start. And that is because the everyone made an awful lot of promises last year. Governments said, "Oh yeah, we're going to do loads about the emissions, and we're going to do a lot about the amount of pollution and whatever it is that goes out into the economy or into the atmosphere." They made all these great promises, and they suggested that we're going to cut back on this, and then nothing actually happened. And the UN has been coming out with reports saying that we are reaching this kind of tipping point where they're now saying that it doesn't actually matter what we do now. 1/3 of all the glaciers in the Alps are going to melt, and you're going to be looking at sea level rises and all this kind of stuff. So it's getting to the point where the poorest countries in the world are really unhappy with the way it's going, because the rich countries like America and the West and whatever, they basically have spent the last 200 years developing their economies and doing all the damage from, when nobody gave a crap about it, they were putting out huge amounts of emissions. Now that they are rich economies, they're saying, okay, now it's time to cut back on all of our emissions. And they're expecting everyone else to do the same. And so the rich countries are basically asking all the poor countries to take this kind of impact. And the poor countries are saying, no, you guys have benefited from this. And so you have to. So COP27 is immediately kicked off with this big row over who's going to help fund the changes that are necessary. And what this is doing, obviously we're all starting to see the soaring utility bills in the economy, and anybody who has a house that was built in the kind of 80s or earlier than that, the insulation levels are appalling, and you just basically you need the heat on nearly all the time, because just the heat just goes straight up through the roof or out through the walls or out through the windows. Brand new houses, the A-rated houses that people can buy now, those are fabulous. I mean, we're in the process of building some at the moment, and we've just sold a lot of them. And those houses are they're going to be incredibly popular with the people, because you just don't have to pay for anything like the amount of energy, and it's very, very efficient. So what's happening is this is actually now the recognition of this. A lot of homeowners are now looking to cut these costs that they are, and they're starting to look at energy efficiency. And how are they going to do that? Well, they did this big survey, and they got a result. 64% of consumers that were lobbied or that were asked the question in this kind of poll, they came back and said that 64% of them are looking to do some sort of work on their house. And this will be funded by the banks and stuff that are actually doing a lot of the funding of this kind of energy efficiency. Now, anybody who is young and about to leave school and thinking about what college and things like that they're going to join, I would say that anybody who is looking at something in this kind of area of home improvement and stuff, there could be a lot of potential there in the next couple of years. And the reason I say that is because they say that this is one of the statements. They say that it is estimated that 20 billion euro per annum of investment is going to be required over the next 10 years to reach Ireland's emissions reduction target. And so 20 billion a year. Now that's 200 billion over 10 years. So clearly there's going to be employment in this sector, and there's going to be opportunities. And anybody who is, in the process of becoming a tradesperson or anything like that, materials, all of that kind of stuff related to this kind of thing, efficiency and making your house greener and making it more insulated and stuff. There's going to be a huge opportunity in the next couple of years. The National Retrofitting Program is aimed at delivering up to 75,000 home upgrades a year between 2026 and 2030. And the idea of that is to achieve an overall target of 500,000 by the year 2030. Now, there's a lot of people thinking that that's unlikely to happen now because of inflationary constraints and all that, but it is still a target that they set for themselves. So 75,000 homes. I think house builders and anyone who is like a trade or a contractor, and those guys are going to have so much work over the next 20, over the next 10 years, or we'll say the next 6 or 7 years, in order to meet those objectives. So it'll be interesting. The same is happening in the UK, by the way, and they're talking about reassessing office use and things like that. Now, the amount of houses getting built in the country they say that it is set to be exceeded, but doubts remain over social housing goals. And so the government is a long way off the 13,000 social and affordable homes that are targeted to build. But this year, the government says that we're expecting to see new homes built, 24,600 new homes built. Now, have a think about that. 24,000 is absolutely tiny. Back in 2007, we were building 75 to 80,000 houses a year. And what's happened is 2008 happened. A lot of people lost their jobs, went abroad, settled down in other countries like Canada, Australia, have not come back. And we're still trying to recover from that situation. And so what you're seeing is the capacity of the Irish construction sector to deliver houses is just absolutely paltry. We can do 24,000, maybe 30,000 houses in a year. That needs to be 3 times that amount. The problem is if you try to bring in builders, laborers from other countries and stuff, where are they going to stay? They cannot actually stay in the country because they can't find accommodation themselves. So it is and then on top of that, we have got the Ukrainian refugee crisis. And so it's all kind of building up. Now, the target for next year is 29,000 homes being delivered, but there's still question marks around that because of supply chain constraints, because of the funding costs with interest rates going up, all of this kind of thing. And they do say that it's basically there are extraordinary challenges facing the sector. Now, on top of that, what they're trying, in order to kind of incentivize people bringing more land to the market, what the tax authorities in Ireland have decided to do is to bring out this new tax, and it's going to be a 3% tax, which will come into force from 2024. But anybody who has a site that is zoned for housing, that is serviced with water and utilities and all that, but they're not building on it, they will have to pay 3% of the value of the site in tax. And the idea is just to encourage people to get out there. And that's really, I suppose we can understand why people are doing that. Now, there's various tax credits being suggested in order to try to help people with rental. A lot of people are coming under trouble, coming into difficulty, obviously, with the cost of living and stuff. So there's a new rental credit of 500 per person in the budget, and that'll be doubled to 1,000 if people are cohabiting together as couple. But a lot of problems are taking place in the market. Like, despite the fact that we're trying to do all of this stuff and get more houses built and get the housing crisis, overcome the housing crisis, we still have these ridiculous problems where housing schemes are being knocked back by the planning authorities and things like that. You've got currently there is a high court case being taken by a developer against South Dublin County Council, and the reason for that is that Jones Investments, they said that they have a 5-acre site that has effectively been sterilized for the next 22 years. So that's a case that's just been brought. There's also a developer taking legal action for the dezoning of a site over near Raheny. Now that is Marlet Property Group they're taking a judicial review because the local council's plan to overturn. They're basically St. Anne's Park in Raheny. There was a large development planned there, and they decided that this was going to be dezoned. And so that he's taking a court case against them because he was planning to build something like 580 apartments on that site. There's also been a refused permission for a Harold's Cross apartment scheme. And this is another example of just 194 apartment complex has been basically turned down. And so you have to wonder, with all of these schemes getting turned down, like, how are we going to overcome the system? And the biggest problem we have at the moment is the Ukrainian refugee problem. And I'll give you an example. I mean, it's every corner of the country is being impacted. But Killarney recently hit the headlines that they're in a situation where they've decided whether they are a tourist town or an asylum town. And the population of Killarney is 10,000 people, and yet they have 3,000 refugees living there. So it gives you like 1/3 of the population is refugees. So you can imagine the pressure that is putting on that. Turning to commercial, and the commercial sector is kind of my area that I focus on. And then after that, after we're finished here, I'm going to go and do questions from you guys. And I see a lot of questions have been put in the chat here. So I'll be getting to all of your questions. But one of the big news is that Meta, which is obviously Facebook, the parent company of Facebook, of Instagram, and of WhatsApp, that company has its headquarters are a place called Fibonacci Square in Dublin 4. And they've moved into this big headquarter building there. And the headquarters just gone on the market for sale for €550 million. And the owner, or the person that's buying it, believe it or not, is the owner of Zara. Now, the owner of Zara is one of the richest men on the planet, a guy called Amancio Ortega. He's a Spanish chap. And he's able to pay this $550 million, and he will have an annual rent from Meta of $22 million a year in rent from the property. Now, what's interesting about this is that at the same time that this is happening, Meta have announced today that they are laying off 11,000 jobs. 11,000 people working for them are going to be laid off. So it is an unusual time for the tech sector. Looking at some of the taller buildings, okay, so I used to love going to New York and places like that because I love all the tall buildings. This is very similar. We're finally starting to see tall buildings being applied for in Dublin. And the problem is they're getting turned down, which disappoints me because I think we could have a city with an awful lot more high-rise buildings. Hello from the Philippines. It's nice to see you. Developer appeals the refusal of Dublin's tallest building. So there's a site when you're crossing the River Liffey, and it's called the City Arts Centre. It used to be an arts building there, and it's like an old building, but it's quite a nice corner site. And a company called Ventaway, they decided to go. They bought this site, and they've applied for planning permission to build a 24-story building of 108 meters tall. And unfortunately, it has been refused by the city centre. So they're now going to go and appeal it from on Bord Pleanála. But on Bord Pleanála is going through its own struggles at the moment. So it's going to be interesting to see what happens. But here's another example of a scheme that is getting kind of held up by the planning system. We really have to do something about the planning system. The proposed scheme will be about 250,000 square feet. 23 floors will be office, and then there'll be artist studios and things like that on the lower floors. Another 15-story hotel building that is planned now. There is an operator being sought for this new landmark building that's being built, and it's going to be 183 bedrooms on 15 floors. And that's going to be interesting. That's being done by the MKN Property Group, and they are understood to have paid about $6 million for the site back in 2019. So, and then there's a development of 40 million for a property out in Dalymount Park in Phibsborough, and they're expecting to spend to put about 40 million into that. So there's a lot going on. There's a church next to the RDS. Those of you living in the Dublin area will know the RDS. It's where Funderland is at Christmas, and it's where there's various conferences like the horse show every year. And the RDS, there's a church next to it. They were the only people that were ever going to buy this church that's next door. The church, I believe, has been deconsecrated. And so it's really just an old, beautiful old structure. But what do you do with these old structures? Like, what can you turn it into? It's very, very unlikely anything can be done with it, because usually they're listed, and maybe you can turn it into some sort of a fancy hall for a restaurant or something like that. But it was always going to be those guys that would buy it, because I can't imagine anyone else. And just a little reminder, Ulster Bank is pulling out of the Irish market, and they're currently selling their mortgages to the permanent TSB. So anyone who has a mortgage with Ulster Bank, you will soon be dealing with the permanent TSB. But in addition to that, your accounts are going to start getting closed in the next few days. Now I'm going to get into questions, and what I'm going to do is I'm going to throw open to the floor. Let me just, if I go and I'll stop the share, and I'm going to open up. So the guys that are looking in on Zoom, if you have a question, put it in the chat. The guys now over on YouTube and TikTok, I'm going to go through your questions. So Evan asks, hi Gavin, do you know with respect to finance any commercial lenders who will lend below 250 for i.e. office overhead apartments, that kind of thing? Like the companies that I'm aware of for that kind of thing could be Castlehaven. You should also look at the possibility. There's a company called Property Bridges, and Property Bridges is kind of a peer-to-peer lending platform. And what those guys do is that you go through the process of putting a proposal together. And when the proposal is fully finished, what you will do is list it on their platform. And those guys will then go and they'll basically put it out there to their members. And you can decide if somebody wants to raise 200 grand, you might have 4 or 5 people say, oh yeah, I'll lend you 50 grand. And it's basically down to the quality of the deal that you're presenting to them. What's the return that you're offering? What are you trying to build? What kind of security would they have? So that's a way to fund it. There's other guys out there like mezzanine finance houses, but they tend to, they won't go below $1 million really. So either the banks, if the banks aren't talking to you, then go to the secondary lenders, I would have thought. Kevin says that, hi Gavin, love the podcast. Was planning to do a house refurbishment and extension next year, although prices probably will still be rising. Is there a sweet spot that happens when demand drops in terms of getting builders and materials? I would say, Kevin, that the likelihood is that the problems you're going to face is, I think the building and the contractors and all that, I think they're going to continue to be very busy for the next couple of years because of what we've been talking about. Like, even if you're not in the process of building, even if the market falls back and people aren't building as much, there's still going to be people that are upgrading their homes. We were talking about the cost of energy and all that. If energy prices are so high, there's going to be an awful lot of people saying, let's go and get insulate the house more. Let's go and put in different windows, all that. So I think there's going to be an awful lot of people out there that are looking at some sort of improvements at their home. So I would say the cost of materials and stuff may not fall. But what I do think could potentially, if you're looking at doing a house refurbishment and extension, one of the things that I think a lot of certainly my clients are looking at, the clients I have in my coaching group, I have a mastermind and a coaching group. And what I have with this group is a couple of guys are doing HMO. And what that is house of multiple occupants. You go and buy a house. Let's say you buy a house that has 3 bedrooms. You buy the house with 3 bedrooms, and then you go and add to that. You might extend out the rear garden, put 2 or 3 bedrooms onto it. Maybe you can convert your attic, put another bedroom up there. Some of the time people have a living room and a kitchen and a dining room. You turn one of those rooms into a downstairs bedroom. So you can go theoretically from say a 3-bedroom house to maybe a 6-bedroom or 7-bedroom house. And what people then do is they rent it out on a room by room basis. And so you will go and find somebody that will come along and sort of pay you $750, $800 a month to live in one of those bedrooms, as opposed to 3-bedroom house. The family will pay maybe $2,000 a month or something. So you could actually be in a situation where you're able to pull in $5,000 or $6,000 a month from the same property, just with these modifications made. Now I'm going to let Adam or Colin in. We have a question here from Jerry. Jerry, out of interest, as a fellow investor, if someone has an emergency fund and is servicing liabilities such as mortgages, what, in your opinion, would you decide to do with excess funds? I would personally, Jerry, I would hold back excess funds because I think there could be some opportunities over the next while. I think certainly in the UK, when they're talking about markets falling and stuff, like if you're able to fix your rates, and so you can kind of like lock out the amount of that your rates are, you should be able to do more with a bit of surplus cash than giving it back to the bank and paying off your debt. It depends obviously on the rates that you're paying and things like that. But certainly cash is going to be king, I think, in the next year. And so I would not be giving up any cash if I can. I would be holding it back. Keep your powder dry, as they say. We've got a couple of big projects that we were going to embark on this year, and we've shelved them just because we'd rather have the cash. And you could go and do a load of work and then find that nobody's there to rent it or whatever. Would I invest in shares? I'm not so sure I would right now. I mean, I would invest in shares at some point, but you'll have to be on the defensive, buying defensive shares. And like, there's a lot of people talking about the market continuing to fall for a while. One of the things that I heard that did interest me was there's a couple of things in terms of commodities. Okay, gold and silver. If you have a think about what's happened in Russia with Ukraine, Russia had all of this money tied up in the Swiss bank accounts and all that. All of that money got frozen and locked out by these sanctions. And I think the Russian, foreign offshore funds that they had was something like 600 billion. That has been basically frozen. And so they're not able to access that now. And that was the first thing that they did when they invaded Ukraine. And I think the Russians were taken by surprise there. And so now I'm sure what these guys are thinking, like the Russian government and any of these guys that are sanctioned oligarchs. And also, if you think about it, the Chinese. Okay, so the Chinese are starting to be at loggerheads with the West. And you've got the situation where the Chinese are, there's an awful lot of talk about Taiwan and stuff like that. If there was any kind of like another international incident regarding Taiwan, we'll say, then this could be something that would happen to the Chinese foreign funds. And so I think they're all starting to think, what are we going to do instead of having our money tied up, locked away in US dollars? And a lot of people are starting to think perhaps gold and silver would be somewhere that they would actually put their money into, because you can actually keep gold and silver in a huge vault in in China or in Russia or whatever. You don't need to, you don't want to necessarily be keeping it in foreign banks that could be sanctioning you. The other thing is, and this is very interesting, if you're thinking about the future of the EV market, would say electric vehicles, and everyone's talking about the greening of the economy and all this kind of stuff. And you've got people like Elon Musk producing so many vehicles a year, and the whole industry has shifted now, and they're all looking at making electric vehicles. And that's all fine, but there is not enough of the lithium that goes into making batteries. There's not enough on the planet to actually continue to do this at the kind of scale that it's been done. So anybody who is producing lithium and anyone who is in the process of mining it or whatever, those are companies that are probably going to see massive increases in their share value over the next couple of years. So those are kind of like outliers. They're not, that would be kind of a long-term hold maybe. And but definitely I'm all for diversification. I don't like to have all of my money tied up in any one asset any longer. I did that before. I had 99.9% of my money tied up in property. And then in 2008, obviously paid the price. Now I'm going to have a look at some of the questions that came in on TikTok, and there is so many of them. Ryan and Colin, who are in the Zoom room, if you guys have any questions, put them into the chat there and I'll be happy to deal with them. I'm going to go back through a lot of the comments here and just see what you guys in TikTok were asking. We have got, we were having a little row about the housing market being in good shape, in my view, and I explained what that was. You guys that are watching on TikTok, by the way, if you want to catch the beginning of this, the entire video is over in YouTube, on my YouTube channel. That's Gavin J. Gallagher on YouTube. So recession, I'm going to be, okay, somebody's delighted that there's a recession coming. Is it not better if there is a crash in housing prices for young people, though? You see, the problem is that the reduction in house prices, yes, of course, everyone would love if prices were reset back to, say, 5 years ago or 10 years ago. Or, I bought my first property nearly 30 years ago now, back in 1993. And when I bought that property in 1993, it was a property in Ballsbridge that I bought for £85,000 Irish. And I ended up selling that, like the guy that I rented it to a guy, and that guy lived in that property for, I think, about 24 years, something like that. And in that period of time, he paid rent for 24 years. And by the time he moved out of that property, he had paid me 4 times what I bought that property for. And then I sold the property, and I sold it for about 700,000 or something like that. So you can see how getting in early and holding on to, it's great. The problem is that what's causing the crash in house prices at the moment is the increase in interest rates. So it doesn't matter if house prices are currently 300,000 and the interest rate was like 1%. And if house prices were to fall to 200,000, you might be saying, "Way, it's great. We've saved 100,000," but the interest rates have gone up from 1% to maybe 4 or 5 or 6%. So the amount that you have to pay every month will be potentially even higher than you would have had to pay when you were at 300,000. So this is the problem with the funding. If the funding falls down again and the prices remain the same, then it's a great thing. But the problem is that it's never a static, one falls and the other one stays the same. One is falling and the other one is increasing. So the benefits you would have gotten from the fall are outweighed by the increased cost on the other side. What else have we got? More likes can attract viewers. Keep it up. Okay, thank you. What's my 12-month forecast in the building sector? I think is going to continue. Well, let me see. Okay, you got to be careful about this. Depends what you mean by building. Okay, if you're talking about the construction industry in general, I think it's hard to say. But I think if you're talking about house building, okay, I think that will continue to perform well. If you're talking about large apartment schemes, I think that could fall off. And the reason I say that is because the market has changed now. And unless the government brings in new incentives to do the apartment buildings, then those are likely to stop. And so it's going to be difficult. Like contractors in general, I think are going to continue to be busy. But I do know I have a friend down in Cork who has a construction firm, and he has seen a couple of jobs shelved and cancelled in the last couple of weeks. And it's part of this uncertainty, and people are starting to just be a little bit careful. Colin asks, "Hi Gavin, I am hoping to buy my first investment property next year with profits from my company. Do you think the timing is good? Also, should I do it personally or through a limited company?" That's a great question, Colin. And one of the things you got to be careful about here is if you buy a property, an investment property through a company, through your company, what you're going to have is there's going to be an additional tax on your company. So when you buy a property in a company, rental income is not taxed the same as the profits that you make from, say, trading. So if you are, let's say you're an electrician and you have a construction firm that charges people for the electrical work you do. You charge somebody 10 grand and they pay you. Your tax rate on that is only 12.5% because that is the trading rate of tax that you pay. But if you buy a property with those profits, you're going to have to pay on top of the 12.5 another 25% tax because of the fact that it is property income. And so it makes it slightly unpleasant. Now, the other side of that is that your profits are locked away in the company, okay? And if, let's say you buy a house for 100,000 and that house goes up in value to 200,000, so you've made 200,000, okay? You sell that house, the 100,000 profit will be taxed by capital gains tax. So it's 35%, whatever it's that, okay? You'll pay 35%, but the money is going to be sitting in your company. Now, that's all fine if you're happy for it to sit in the company and maybe you'll make another investment in the company. But if you decide that you want to take that money out for yourself to invest personally, then you're going to go and have to pay tax on the distribution to yourself as well. And so you'll end up with 30% CGT in the company, and then the distribution to yourself is another 50% tax or whatever it is. So that can be quite a negative thing. One thing that you might look at is transfer the money into a self-administered pension fund that your company sets up for you. And then you can buy the property in the pension fund totally tax-free. And that is something that I've done before. And it's something that I know people are doing. And it has to be arm's length transaction. You can't rent it to yourself or any of that kind of stuff. And it has to be completely third parties that are renting it. But if you're able to do that, it's all the rent is tax-free. All of the profits, if you sell it later, is tax-free. It's all contained inside the pension. And then eventually when you reach the age of 55 or 60, whatever it is, then you're able to release that. And it's a really great way if you're looking at locking away wealth, on the long term. But if you're talking about, I want to make a few quid so that I can, upgrade my house or buy a bigger car or whatever, that kind of thing, then you're talking about trading, and you're better off doing that in your own personal name, probably, so that that money is in your hand. But I would be wary of doing that kind of thing. Ryan asks, speaking as someone interested in a partnership whereby we would bring the skills of a construction firm, what would you look for in return for your investment in a partnership in yield terms? It depends, Ryan. That's a good question. I mean, what I would be doing, Ryan, is I would be looking for, like, there's three types of partnerships. You can have a partnership that is like a silent partnership, where you bring somebody into the deal and they are silent. They are just literally a dumb partner that is giving you money. And they say, look, I have 100 grand. I want you to go and do something with my 100 grand. So you might say to them, right, I will pay you 8% a year for your 100 grand. And at the end of 12 months, you give them the 8 grand plus the 100 grand back. That's a very, very simple way to do it. Now, because rates are increasing and all that, it could be that 8% is no longer going to cut it, and you might need to make that 10 or 12% or something like that. You're going to have to test the market for that yourself. The other way, though, to think about it is to look for strategic partnership. And rather than you arriving in as the construction firm and you're going to do everything, you can partner up with somebody that either has land so that you don't need to pay for the land, or like you're putting your construction, the value of your construction, and they put in the value of their land. And it means that you're not having to go off and borrow huge sums of money and whatever. There's a possibility there. The other way to look at it is you get a strategic partnership with somebody who can introduce you to, say, a bigger, pot of investors or something. So, like, I've gone off and I've done deals with wealth management firms. And if you do a deal with a wealth management firm, the benefit there is, instead of dealing with one investor, you're dealing with the head of the wealth management firm, and he'll go and he'll spread the message to all of his clients. And you might end up with 100 clients that are interested in investing in your scheme. Now, that could mean that you could raise large sums of money. You'll obviously have to demonstrate track record and all that kind of stuff, but it is a good way to do it. Just responding, Colin has come back saying, is it allowed to transfer profits tax-free from a trading company to a sister company and buy? What you can do is you can do, I think, an intercompany loan. But it is still going to be owed. The other way to do it is actually, it can be just, you've made 100 grand in one company and you lend that 100 grand to another company, and that company goes off and it buys the property or it does whatever. That is something that you're allowed to do, like a sister company. The other way to do it is to lend the money and actually, earn interest on the money through, and that's a way of doing it. You eventually take wages from the property company when there's enough surplus rent. Yeah, I mean, that is a way. I know people are doing that. And it is certainly safer than if you're going and you're doing a lot of kind of risky deals and you're buying property and the property, falls in value. You can just let the company go. I would definitely separate them out. I would not buy property in a trading company. If I have a plumbing company, I'm going to want to have a property company that is completely separate. And what people sometimes do is they'll create a third company. It'll be like a management firm. And what you'll have is you'll have your company that produces, that does, say, the plumbing. Well, I'll just use plumbing as an example. So a contractor is able to do the plumbing in one company. Then you have your property company that's buying and selling the property. But then you have a management company that you're able to you'll be able to charge fees to clients that you bring in and all this. And it's a nice way to just keep it kind of separate. Now, you don't want to create too many. Yeah, obviously, it depends on the scale that you're operating at. You don't want to create too many entities because you have to kind of keep the cost of those entities running and things like that. But it is worth considering. Look, guys, I've got a meeting starting in about 30 minutes, so I got to get going, but I'll try and cover some of the questions, these final questions. What's up new here? Blah, blah, blah. Let me see. ICE is the best for mortgages. Is it time to ditch the tracker mortgage? Yeah, a lot of people are talking about that. Is this group on Discord? No, I must look into that. Let's have a look. What are we saying here? Can a recession be a good opportunity to make money? It's one of the biggest opportunities to make money, but you've got to be very, very careful, and you've got to watch your mindset. Like when you're going into a recession, everyone around you is going to be panicking. People are running a mile from you, all of that stuff. That tends to push down sentiment in the market. And if you're a person who gets impacted by sentiment, and if you're a person who's going to be there kind of like swayed by the way the market, then you won't be making those kind of bold moves to buy property when it's at the bottom. And so if you can resist the headlines in the newspapers and things like that, that can be a good way to make money. And like some of the biggest money makers are the ones that go against the market. I mean, look at John Paulson and this other chap, I can't remember his name right now, but the guys that basically bet against the housing bubble back in 2008, they became billionaires like overnight because they just went so against the market. Everyone was calling them idiots, and they were able to resist that kind of mental pressure of being called idiots and being questioned every day and all that. And like maybe a year and a half or 2 years later, they suddenly were there. I've just made 15 billion, thank you very much. And so it was obviously proved them right, but it just shows you that you have to resist a huge amount of people telling you that you're a fool, you're an idiot, you're doing everything wrong. And you need confidence. You need to be confident to be able to do that. Is it a good idea to move pension into low risk investments at the minute? I've 19 years in Zurich. Like, I think low risk. Yeah. I mean, everything is risky at the moment in terms of pricing and stuff. I would say I've already talked a few minutes ago about, commodities and stuff. Commodities do seem to be like gold and lithium for batteries and stuff. They seem to be stuff that people are looking at. What if the tech multinationals leave? Will there be loads of properties up for grabs? I don't think the tech multinationals are going to go anywhere. I mean, it's always a risk, but there's plenty. The reason they're here is pretty well established at this time. Why private landlords are selling? Yeah, you're right. When is my book out? I'm writing it at the moment, and it's going to be out soon. But an exact date, you'll have to stay tuned. They gave stats that said between 1990 and now the temperature has increased. Yeah. Oh well, look, people are kind of pushing on. What about restrictions, short-term rental, Airbnb? Yeah, there is a lot of restrictions on that, and you have to kind of consider whether it's worth your while. You definitely want to go and study the market before you go and jump in, because people sometimes they jump in thinking that everything is going to be great, and then they realize, oh wow, I wish I had known that before. Okay, guys, look, I'm pretty much finished here. What's the best bank to go for an investment mortgage? Go and do your homework. When do you think property prices will hit rock bottom? That's a great, rock bottom. What is rock bottom? There is people in the commercial sector, certainly, they're kind of the view that maximum pain will be Q2 next year. That remains to be seen. It's all down to where the rates are going. If inflation turns into this 3-year thing that they're talking about, then it could be 3 years from now that the market is still being pushed down. And it's like, the problem is crystal ball gazing. Like, what on earth can you say about this? Thanks for the information, guys. I hope you enjoyed it. This is going to be in the YouTube channel if you want to go and watch it. And I'll see you guys the same time next week. And I hope you enjoyed it. Thanks, guys.